And today we're gonna review Netflix earnings, which just came out this evening. And the stock's trading down pretty aggressively. I think it's kind of started to stabilize a bit here. I actually did not go into the quarter with position. It was a very interesting quarter. Yeah, down 8% and change. And I think a lot of why this is, well, there's a couple of things that it could be. Overall, though, this was a really good earnings from everything I saw. Let me show you what I saw. Past performance is not indicative of future returns. I feel so thankful that I just closed it out because the thing had run up so much. I was just like, ooh, I don't want to be in this. But there's no reason other than, let's just go through it. Let me show you what I saw. Okay. So here's the spread. They give a spreadsheet that shows all of their financials all the time. And if you look at what the numbers were, it was revenue up 2.7%, operating income up 15.77%. Let me try to increase the size of this so you guys can see this a little bit better. Let's see. Yeah. And I think it's really important to look at operating income because a lot of these big companies, they have these other interest income and expenses. And it's usually something that they invested in that just ends up messing up the numbers. Last year, it actually helped them, even though the quarter was legitimately pukable, for lack of a better way to describe it. June of last year was problematic, and the stock pretended like it was not problematic. Now we're kind of getting the reverse here. But that was this other income that they had 87% up. And if it wasn't for that, you would have about a 15% improvement. Now I want to show you, so instead you had about a 3% bottom line growth. So I think this puke out, if people didn't understand what this was, that's probably a little bit overdone. Now also some of this is FX. So you do have FX kind of playing through here a bit. But it's not as ugly as it was in the past when they didn't manage their FX very well. So I'm not necessarily thinking that makes sense to kind of ping the stock for. I do want to show you this spending shift, though, because this to me is the reason why I get very interested personally about Netflix. And that it has to do with the fact that as we go into the writer's strike, the thing I cared about, which as we go in the writer's strike, the thing I actually cared about, not convinced that everybody else cared about it, was how exactly are they sourcing their movies and films and and media, let's call it. And the reason that I say that is because unlike other film companies or media producers, especially the legacy producers, Netflix gets a lot of its stuff overseas, which means it's not beholden to the writer's strike. And so I was really interested in, if Netflix gets clobbered today, how do I want to play it going forward? And that's really kind of where I think other people should look at it. Okay, let me go back to sharing the screen here. Let me go back to sharing the spreadsheet. I want to show you how some of this played through if you're also interested. So tech and development, obviously we know last year they were all about trying to figure out ways to get people to pay for this instead of sharing it. So a lot of that spend is decreased quite a bit, quite frankly. And similarly, they plowed that money into marketing. You can see that clear as day. But let's go actually into the thing that I was talking about as relates to, are they going to benefit because they just don't necessarily source all of their media from the US? Now, I want to show you a couple of things here that I saw. First, a little bit off topic, is this right here. This is a huge increase. This is like almost, this is almost $2 billion in increase in cash. Okay. And then some of it's short-term investment. So we're really talking almost $3 billion worth of additional cash right into a scenario where we have the highest, rates that you could possibly get on cash. Now, they do have debt against that, but Netflix debt is cheap debt. Okay. So that there's no way that this long-term debt is done. I haven't had a chance to look it up, but I'm sure anyone else could, but there's no way that this debt is done at some crazy high rate. Okay. So my suspicion is this is sub 5%, which means they're running, this cash is paying half this debt off as they go. So realize that. And then as I was looking through it, I was like, wow, they're generating a lot of cash. Here's the content assets, more or less that stayed flat. Now, the way that you want to think about that is they're amortizing this as they go. So that actually means that even if they increase and re-up, some of the old stuff that was not theirs is running off, and some of the new stuff that they're making is going on there, and that really improves their operating costs. So how do I mean by that? If you're still trying to understand this concept of if you're trying to understand this concept of amortization as relates to media assets, it's like this. They made Bridgerton. That goes into that particular line item, which is content assets, but it gets depreciated, as time goes on. One of the things they actually talked about in the call, and this is where you'd find it through the financial statements on the balance sheet as well as in the cash flow statement, is that when they do a new kind of episode of Bridgerton, or alternatively, the newest thing is actually kind of a spinoff, then what happens is people tend to watch Bridgerton. And since Bridgerton is owned by Netflix, it's not something that they licensed from someone else, then what happens is that essentially it's pure profit. It's pure additional profit, but it's getting depreciated on the balance sheet. So it looks a very particular way. So this is actually a really cool thing that I'm always watching here going forward, because this is a multi-year situation where they have content assets that they then get to depreciate going forward to reduce taxes, for lack of a better way to say it. And we're seeing they just continue to re-up that, and that's pretty awesome in my opinion. Cash flow, I want to show you this. This is exactly what I'm talking about as relates to the writer's strike hurts them differently than it hurts other people. Now, what you kind of want to understand and realize about really any of these guys is that the media is made first, like 6 months, and then it's edited and all this other stuff. So some of this this is going to be the spend that they did 6 months ago as much as anything else. Okay, so just realize these are already in process. Still, this is down 21% as far as additions to content assets go. Okay, so they're spending about $1 billion less, according to cash flow statement, on additions to content assets on the go forward. And I think this 100%, and that absolutely, by the way, helps cash flow from operations. That's what allows you to have this beautiful, huge, ridiculous pot of money, for lack of a better way to describe it, which I think is going to be really smart as we enter the writer's strike, because it'll allow them a lot of financial flexibility to do different types of things, to either promote the shows or find places overseas that they could create or buy content. It'll make them one of the strongest players when they go to buy any content overseas. So this is kind of a big deal that I thought was very interesting. Doesn't necessarily help the fact that the stock is down 8% right this minute. But if you own Netflix and you're not going to touch it, or you were concerned that this 8% was something meaningful or something really bad happened in the quarter, nothing bad happened on the quarter. Okay. So that's kind of the answer to that. And you can kind of see this spend right here is most of the net cash flow from operation increase. Last year wasn't as great. Okay. Last year they had a lot of problems that they've been fixing for the last 3 quarters. I really think it's probably one of the faster fixes I've seen in a long time. So that's very impressive. Now, the last thing that everybody focuses on is subscriber growth. You had 6.2 million ads. That's a huge number. I don't know another way to say it. That's actually a huge number. We all know what that comes from. It comes from their whole, like, you're not allowed to share anymore situation. And we can see that in particular, we can see it in the fact that they're no longer losing. You've got net ads in the US. Now, I really want to talk to you about this when you're looking through this. One of the things to realize, and one of the theses that I've had, is that if Netflix could just figure out its international business, oh my goodness, because they already have most of the US business. I mean, their subscriber, if you look at like the total subscribers in the US versus overseas, you'll see that they've got a really good size market share. It's usually in the quarterly document that they give you, but they have a huge market share. Realize, though, that they always leave YouTube off of that, and YouTube has an equivalent market share. If not, a lot of people like to pretend like that's not media. It is so media. So let's just, not get confused there. But Netflix, this ability to grow the US is a big deal, but what I care about more than anything is what's going on overseas, because I do think that the future of Netflix, this is like, whereas the US is always going to be nice, easy, let's get to the max that we can for saturation and then hold the line. There's still a lot of growth potential in Europe, Latin America, and Asia. And I was really shocked. I saw really good numbers there. Now realize that the average revenue per membership is lower. Okay. In the US, it's not lower. Okay. They charge us. We know it. It's more or less flat on the average membership. But in Europe, some of this is you can kind of they I really wish, on a constant currency basis, even this price came down fair and square. Okay. Now remember, Europe also has the Middle East and Africa. One of the countries that we know a lot of the media is coming from is Turkey and other areas there. So, you kind of have to price in a way that's reasonable for what's going on and what's realistic for that region. Latin America, pretty freaking amazing there. You're still seeing the ads. Again, it's very little pricing that's causing this, at least for Latin America. And then subsequently Asia, they are doing a much more aggressively on the pricing side, and that's because they kind of have to. But I'm still really excited to see this revenue up a lot, and this paid membership increase is gigantic. So overall, for me, this is a great quarter. It'll just come down to valuation. I'm keeping this one really short because there's not a lot to say, in my opinion. This was a good quarter. I'm going to look for a place and a price that makes sense on it right now. Let's see, using the old numbers, the stale numbers are, and it'll be approximately the same given what the quarter did, but it's trading at about 10 times enterprise value to EBITDA, 42 times forward earnings is what they're saying. But I prefer enterprise value to EBITDA because, particularly for Netflix, given that there is now so much depreciation, number one. And number two, also very important, there is there's so much cash. You kind of have to, if you're going to compare across other media assets, then I think EV to EBITDA is more fair. And so at 10 times, it's neither cheap nor expensive, but let's see what happens, because I think I have in one of my retirement accounts some Netflix from a million years ago. I wish I had more, but the boys that I was around at the time talked me out of it because this is before I learned not to second guess myself. That's kind of what I'm looking for. All right, let's look at questions. Thank you guys so much. Oh my gosh, you covered your short. I'm so sorry, MH. Guessing on earnings is the toughest. I actually went into the quarter with a calendar spread. I had 500, 505 diagonal. So I was long next week, short this week. And the thing rallied so aggressively. I was like, whoa, I'm out. That's too much. I'm just going to take my profits. I don't trust this. This is too big a move. So I got lucky and closed it out at the end of the day. I'm sorry, MH. That would have been a beautiful payday. Juicy Guy, you crazy. Thank you so much for stopping by. Trendboard, you got so many great comments on here. Let me make sure I got what you're going. Yeah, I totally agree with you on this one. I do think that Netflix will dominate the space, particularly during the strike. What it will do thereafter, we'll see. There's always contenders that come up, but right now I think Netflix is doing great. I still think that one of the biggest contenders is YouTube, but technically no one considers them a contender. And also Google, the owner of YouTube, we all know, has so many fish to fry. It's sometimes, I feel like if you had people that wanted to crush Netflix at YouTube, they would really give Netflix a run for their money. But right now, it seems like they're doing other things. 100%. This 6 million new subs is insane, right? Like that's actually a really big number, and is part of the reason probably why it traded up. Maybe some really clever person already knew that was the case, and that's what was happening. What we got? Split the stock. Corey, I agree with you on this. A lot of times people say oh, a stock split, it does nothing, just have less shares, yada yada. But I do think there's something to be said for a company giving the opportunity for folks that don't have $500 a share to buy it. Otherwise, this becomes a wonderful Christmas gift that you get yourself, or a wonderful birthday gift if you've got a summer birthday, to try to give yourself. This thing ran up so aggressively. I would. I'm trying to do only fundamentals on mine because I'm not really the best chartist out there, so I feel a little concerned. But I would say this one probably goes to the technical people if you're looking for an entry point, because it's very momentum-y out there right now. What you got here, Trend Boys? It's like a discount heads up. Actually, it started a movement. Now Costco's doing the same. Yeah, it's interesting that way. I think you're right. Yeah, they're getting them. They certainly are. Well, that's all I have prepped. I will try to do one on Tesla as well, which had an amazing quarter. And I think the stock's kind of chilling out. I don't think it's as aggressively reactive because Tesla got clobbered so much last year that a lot of the first part was just retracement. But we'll take a look at that. And I owe everyone some stuff on the banks. It is very interesting, but it does look like the banks are going to make it through and that we may not have any runs on the banks. But we shall see, because some of the slim shadiest ones still have to report. So that's what's up right now. Have an amazing night, guys. See you next episode. Bye.